So here are our four primary trade types. I call these the four primary trade types because these are the four most common VWAP related trades that you're going to see. This is all intraday VWAP, but it will apply to multi-day VWAP when we get to that. The first thing I want you guys to notice about the four primary trade types are that type 1 and 2 are both of the trend variety. Trade type 3 and 4 are of the counter trend variety. So trade type 1 and 2 go together. Trade types 3 and 4 go together as well. Now, you'll also notice that in each grouping, there is a trade that occurs at the VWAP and a trade that occurs at the standard deviation band. In the same sense, down here for counter trend trades, we have one occurring at the VWAP and one occurring at the standard deviation band. Note that there are no trades that occur at the 2 deviation band. We are not trading back inward from the 2 deviation band back towards VWAP. I've found that a market that is actually at the 2 deviation band is almost equally likely to continue trending, because kind of like, how did it get there to the 2 deviation band other than most likely someone rapidly purchasing or selling that stock for a reason? And it's not a guarantee. It's not always going to continue. It's just simply that I don't teach any of my trade types with reference to the 2 deviation band. Trade type 1, which is called a test trade type, is one of the more simple ones, and I think one that we've all probably seen before. I'm going to draw a basic example over here on the side. Let's say we have a volume weighted average price, and price comes down to test the VWAP before rallying off of it. Now, obviously, just to be clear, we could also have a short trade setup mirroring that to the downside. But for right now, let's just stick with a long type 1. So a bounce off of a volume weighted average price. What this represents is market participants coming back in at the average, having previously, let's say, paid more than average for this stock. They're coming in at the average to defend or to continue purchasing that stock from the average price on upwards. You may ask yourself, well, if they're really trying to get it at a discount, they didn't want to buy it all the way up here, why would they be a buyer at the average? Why not wait for the market to go to a strong discount below the volume weighted average price? And the answer is simply scarcity. In the event that somebody has been, let's say, purchasing this stock all day, and then it comes back to the average price, if they are still a purchaser of that stock, and they believe that it's going to end the day much higher than where it is now, the VWAP price at which they purchase it, which is, let's say, an average at the time, is going to look like a discount at the end of the day. So if you can imagine, let's say we'll put a C for close. Let's say we close the day all the way up here. Would you like to have purchased this stock down near the average price? Well, absolutely, because by the end of the day, the average looks like a discount. So simply put, what a test trade is showcasing here is a market that is being defended at the VWAP by other large participants. And that gives us an opportunity, like I described before, to structure our trade. Ooh, that's not a straight line. To structure our trade, there we go, with a stop just below that recent low occurring at or near the VWAP. We can get in after we've seen a little bit of confirmation in the direction the market is resuming its trend with a tight stop and a very asymmetric and favorable upside. A test trade is called a test because it is do or die for that stock at that time. In the event we have, let's say, our VWAP here, and price comes down to it, bounces a little bit, but then kind of melts through it, well, that has failed its test. It did not bounce and resume trend and continue to new highs. Instead, it reacted very weakly, light little bounces at the VWAP before crossing and going lower. If a stock is destined to end the day all the way up here, it's probably going to bounce at the VWAP because the traders who are in control of that market, well, they're not going to sit back and wait for the market to drop all the way below VWAP. That would be too convenient. If the stock is really in high demand, it's going to get purchased up from VWAP to its eventual end target. Now, of course, we can't know that in advance, but do you see how I'm kind of connecting the idea of a stock that is going to make it all the way up here is also a stock that will probably be defended at the volume weighted average price, because the institutional traders are going to see that as a nice opportunity to get aboard this chart at what will look like a very favorable price by the end of the day. A continuation trade is a trade that would occur, let's say, when we have a rising VWAP, we've got our deviation band, and maybe the stock, which had been bouncing back and forth, is now breaking up and out and finding support at the deviation band. Notice it is tempting for traders to say, I will wait for it to pull all the way back to the VWAP, and I'll take a type 1 trade if we bounce at the volume weighted average price again, because we've already done that twice in here, right? But why would a stock that has already bounced at the VWAP, it's already succeeded multiple times, and now is getting up into the fast lane, why would that stock retreat all the way back to the VWAP? Wouldn't that almost be too convenient for all the other traders? That'd be too easy. Do you see what I'm saying? It would almost encourage everyone to just simply wait for a reversion to the VWAP. Strong trades that break into the fast lane and then find support or further defense at the fast lane, that's another indicative action that the market is really trying to break in one direction or the other. You could think of the deviation band as like the new normal, the new VWAP support during an extended or heightened trend. Obviously, it's called a continuation trade because it's a continuation of an already established trend. A reversion trade, so the first of the two counter trend trades, I always describe this to people as, have you ever seen a car that's been in the slow lane and starts trying to merge into the fast lane? So again, we've got our slow lane and our fast lane here. But as the car comes into that lane, let's say there's a big truck in the way and they honk their horn, making the car swerve back into the slow lane. That's effectively what's happening with a counter trend reversion trade. What'll happen is we'll come up to the 1 deviation band or down to the -1 deviation band. And instead of being able to get into the fast lane, we're going to get strongly rejected there. We're going to get pushed back and away and down from that deviation band because the market is unwilling to break into the fast lane and therefore unwilling to really trend higher. This makes for a relatively safe pullback towards the volume weighted average price. Because if you remember the idea of magnetism, during a slow lane, we're more likely to get magnetic reversion or attraction back towards the VWAP. Whereas during a trending VWAP, getting up into the fast lane, that's where we tend to get magnetic repulsion and trend movement away from the VWAP. A reversion trade tends to have much smaller, let's say, expectations, if you will, for the profitability of the trade, because the target is really from the 1 deviation back to the VWAP. It is possible we will go even lower still, but you can't necessarily bank on that or make that part of your trading plan. A reversion trade is really only from the dev band back down towards the VWAP itself. And then finally, we have the last of the counter trend trades, a cross, type 4. Now this one trade type is particularly hard only because in the moment when we come back to the volume weighted average price, we don't know if it's going to bounce or if it's going to break through. So we don't know if it's a type 1 trade or a type 4 trade. Now, obviously, we're going to get some confirmation one way or the other. We're going to either see it start bouncing, more like a type 1 trade, or it's going to cross below and start maybe consolidating below, which would mean more of a type 4 trade. The key here is that for a type 4 trade, meaning when we actually cross the volume weighted average price, here, let's clean this up a little bit. We actually cross the volume weighted average price, what we expect to see is like a lightning bolt to the downside, because the cross of the volume weighted average price was pretty significant in showing that the market is no longer willing to live above its VWAP and is in fact crossing below the VWAP now. Being below the volume weighted average price means people are unwilling to pay what other people have paid on average for that stock throughout the day. So if people are unwilling to pay more than average, what kind of hope do we have of ever getting up here, right? We have none. Meaning if the market fails below its volume weighted average price, and especially by some considerable margin or with decent volume, well, then what we tend to expect is a significant breakdown, and the cross of the VWAP itself will be the important tipping point. One thing I have observed is either during a strong cross, you will get a reversion back up to VWAP before the eventual move down. And this type 1 short may be significantly better than the initial type 4 cross. It'll be an easier trade for you to enter. However, there's no guarantee that it's going to give us a retest. It's actually very possible, let me draw this in as a hypothetical too, that we bounce off of VWAP multiple times, getting weaker with each time before we eventually break down. At that point, that is a very powerful type 4 trade, representing a kind of tipping point in balance between people who wanted to support and defend this stock and people who didn't. Right? The people who are no longer trying to support the stock seem to be winning. Right? They prefer it at lower and lower prices.